Okay, perfect. We will begin. Hello, my name is Mark Noble. I'm the Executive Vice President of ETF Strategy at Horizons ETFs. The recent volatility in crude oil prices, particularly the period in late April that saw WTI oil prices briefly go negative, has brought many energy and energy-related equity strategies back on the radar for many investors after, I would say a good decade of not ignorance, but people sort of avoiding the space. As the firm with the largest selection of energy-related ETFs in Canada, we've had a lot of interaction with investors asking us questions such as, has oil bottomed? What's the best way to play an energy rebound? Or some of us are even asking, should they be avoiding energy sectors altogether? Now, buying a crude oil commodity ETF or an energy sector ETF isn't as straightforward as buying other investment mandates. Clearly, there's a lot of opportunity, and we're going to go through that today. But there's also, of course, there's a lot of risk, which we'll also try to highlight. With us today to help us is Nicolas Piquard, Vice President and Portfolio Manager at Horizons ETFs. Nick is a leading options and derivative strategist at Horizons with expertise in energy and commodity markets and running a lot of our covered call mandates. Nick and I will talk about a number of the energy solutions today, mainly focused on crude oil and energy equities. However, Nick will also talk about uranium, and we've added uranium to this webinar because it's had a stunning turnaround this year, and Nick is really a leading authority on investing in uranium. So the last part of this presentation will provide some of the views on why uranium might be potentially the biggest winner in energy investing. But the bulk of our presentation today will be focused on crude oil and energy equities. Before we get started, I'd like to go over a few items so you know how to participate in our webinar. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane on the control panel. We won't hit those until the end of the presentation, but we do encourage you to send in your questions at any time, and then we will collect them and address them at the end. If for whatever reason we don't answer your question, or you don't feel it was adequately addressed during the webinar, we revisit them within 24 hours with one of our customer sales, our client service representatives reaching out to you. Perfect. So just looking at the agenda for today, we're going to start just talking about what's happened in the crude oil markets in 2020. I'm assuming that's brought a lot of you here today to try to get a better understanding of what's happened. The explanations are actually fairly simple on what's happening, and we'll go through the opportunities there. We're going to talk about commodity ETFs. Commodity ETFs aren't as straightforward as many investors may think, particularly if you're new to this space, so we'll go through some of the mechanics. We'll talk about investing in different types of energy ETFs. And as I mentioned, finally, we'll talk about alternative to oil, which is uranium, which has had a stunning reversal over the last year and has been one of the best performing asset classes and commodities of 2020. I love this picture. It's from an article in April 22nd, 2020, and it's showing you sort of the, bottom end of the Gulf of Mexico and the Pacific Ocean, Texas and California, the two most car-dense sort of states in North America. And what you're seeing here is a record 20 million barrels of oil floating off the U.S. West Coast with nowhere to go. And so what we saw at the end of April was something that had really never been seen before in history, which was the fact that we had no usage for oil that had come across the world to the United States in some cases, or across from places like Cushing, Oklahoma, where storage capabilities were completely full of oil because the world has simply gone to a standstill. There is nobody driving. I don't know if you've had the pleasure of driving on any of the major highways here in Canada, but they're quite a bit quieter, and it's the same in the United States. And so when the world goes to a standstill, what we would typically expect of a strong driving season completely was eliminated with demand for oil. And so what occurred at the end of April was that, generally speaking, people invest in oil using futures contracts, and the futures contracts determine, if you're going to take delivery of oil. As we got to the end of April, what happened is as these tankers and all of this storage and excess oil came into North America, there was simply nowhere for it to go. And so for the first time in history, investors and oil tankers and different types of oil exporters were being paid to take delivery of oil simply because of no capacity for it to use. And you can see in real time just how unprecedented this spike is. This is the buildup of U.S. stored oil, and you can see that the blue line here is showing that we're well above the most outside ranges of how much oil was already in the U.S. marketplace, with over roughly about 550 million barrels of oil sitting in storage. Again, nowhere for it to go, which means that if I'm trying to export oil, somebody is taking delivery of that. Now, how long does this last? Do we see this type of massive overhang of oil storage persisting through the crisis? We don't know. I mean, that's the simple answer, simply because we don't know how long social distancing measures go, driving goes, but certainly we've seen a fairly strong bounce back from the April negative prices. And Nick's going to really get into some of the outlook on supply and some of the drivers that we might see where oil maybe starts to come back into favor on the latter end of this year, and usage starts to come back into favor. Thanks very much, Nick.
Thanks, Mark. Yeah, and so the outlook on supply has really changed over the past couple of months. I mean, it was only in early March that Saudi Arabia had effectively declared a price war with Russia, which really started this precipitous decline in oil prices. I mean, at the time, the crude oil market was being impacted by COVID, but mostly out of China, and it was already weak. Demand was already weakening, and OPEC was trying to implement a smaller 1.5 million barrel a day reduction in production. But instead, because Saudi Arabia and Russia couldn't agree on those cuts, Saudi Arabia announced price cuts and an increase in production of several million barrels per day. This led to a complete collapse of the oil price. But the fact of the matter is, Saudi Arabia, which is the biggest producing country, still needs oil to trade at $80 a barrel to balance their budget. They can't afford to have oil at these low prices for that long. And so this was certainly one of the motivations behind striking a deal with OPEC plus, OPEC plus Russia, less than a month after this price war began. Saudi Arabia and Russia, as well as the United States, realized that without significant cuts and this drastic shortfall in demand that we see would have a long-lasting impact on prices. The cuts were agreed to were amongst the largest cuts ever announced at 10 million barrels per day. And according to the IEA, we could see further cuts of 5 million barrels per day from non-OPEC producers. And we see this in the rig count data out of the U.S. It is now at 10-year lows. But what's most important to me is the longer-term effect this crisis is going to have on the supply side. The longer-term picture is that companies across the board, globally, all over the world, have not only reduced, expansion plans, they've reduced capital expenditure plans, and so in the short term, this is going to impact production. But it also impacts production on the longer term as well, because a lot of expansion projects that were being looked at are being shelved indefinitely.
So just so we understand there, Nick, so you're talking about complete supply destruction occurring right now across the world.
Exactly. And really, I think what people underestimate is they see this supply destruction happening now and kind of evening out the demand destruction. But what we don't fully realize is the longer term impacts of the supply destruction. Because let's look at demand. If we look at demand, we think that demand is going to recover a lot quicker than supply. And we see this from the chart here on the world liquid fuels production consumption balance. This chart shows that we're forecasting consumption to improve and surpass supply by the end of this year. And so all those extra inventories and oil that we've been putting in inventory over the past month, that's slowly going to come down. And we're already seeing that. If we look at the next slide here, sorry, I'm having a little trouble Go to the next slide here.
Can move for you. There you go.
Oh, there you go. Thank you. Yeah, if you look at this slide, we see that according to the IEA, April demand was lower by 29 million barrels a day. That is a significant drop, almost 30% of demand. But their forecast is that over an annual basis, by the end of 2020, we're only going to see a 9.3 million barrel a day reduction, which is less than the 10 million barrels a day that OPEC has decided to cut. So I think there's a good potential that the market could come back in balance sooner than we think. The other thing that we have to look at is the Chinese example, because the Chinese were the first ones to go into lockdown. They were the first ones to get out of lockdown. So we don't know if they're going to go through a second wave, but what we do know now is that Beijing and Shenzhen traffic levels, which are amongst the largest cities in China, are back to levels from 2019. To me, given that oil represents, oil consumption is 60% is consumed by transportation, this is a good indication that demand is recovering relatively quickly. The other thing we got to point out is, China is the second largest consumer of oil in the world after the United States, and they really depend on imports for a large majority of their consumption. And this might be an opportune time, given the weakness in their economy, to expand strategic oil reserves in that country at these low prices.
So what I'm going to do is I'm going to talk a little bit about commodity ETFs and how they work relative to investing in oil. Because what Nick's done is he's provided you an outlook on where we could see the fact that, yes, demand is at all-time lows, but if we start to see drivers return in North America, we're already seeing the Chinese economy come back on, and now you've got this secular long-term demand destruction. Remember, once you stop drilling in places like the Permian Basin or in other parts of the world, you can't just turn that right back on. You're talking about months of trying to get that infrastructure back online. I mean, we see that a lot of the drillers kept trying to drill through March simply because they wanted to maintain some sort of footprint if there was a recovery. But what you're likely going to see at some point is that demand comes back to maybe not 2019 levels, but certainly better than what we saw in March. And driving statistics are already starting to show that there's some improvement in April, and I would expect that you'd see that in May, and you have this supply. So if I'm an investor, I'm thinking, great, everything sort of seems to be aligning. I'm going to go long into crude oil, thinking that I can just do a buy and hold into crude oil because oil is likely going to rebound. Unfortunately, it doesn't work that easily when it comes to investing into crude oil. When you're investing in crude oil ETFs, and this is generally the most liquid and most efficient way for investors to buy commodity ETFs, what they're going to be doing is tracking the futures contracts rather than the price of oil. And it's one of the big points of confusion for investors is that the price that they tend to see when you're watching Bloomberg or BNN or reading the Globe and Mail or wherever you get your information, they're talking about, Brent oil or WTI oil, hopefully showing WTI oil when they're showing the North American situation. But that's not an investable thing. You cannot buy spot oil. You can only get the spot contract of oil if you have the ability to have some sort of commercial storage facility. For the rest of us investors, we need to be buying futures contracts. And when you're buying futures contracts, you need to understand how those futures contracts work, even when they underpin like an ETF. So for example, one of the things that we tend to see, particularly when there's a longer term bullish outlook for something like energy prices and oil prices, is that the futures contracts that are trading past this month are trading at a higher price than the current futures contract that the ETF might be holding. And this means that every time that ETF rolls, it's going to be paying a premium to roll into that next month's contract if it has these shorter dated contracts. We refer to this as contango, and that is when the futures price is above the expected futures spot price. And with the passage of time, the futures contracts will generally decrease as they converge with the spot price. But if you have to keep rolling those contracts, if you're holding one of these ETFs for 6 or 7 months or 2 or 3 years, if the price of oil doesn't go above at the point of the maturity of the contract, if it doesn't go above the next futures month's contract price, then you could actually lose money even if the price went up slightly. And certainly we've seen that occur. We also have something called backwardation, which is important to understand, is sometimes the opposite occurs, where demand for oil is so great and supply is less that you actually don't have any storage costs, and you could actually see the futures price be below the expected future spot price. We don't tend to see that as often, but it does occur. But if you're going to be buying commodity ETFs, you need to understand both of these basic factors. It's very different than buying a stock where you have a view that a stock's going to go up. If the price goes up, you make money. If you have a view that the price of oil is going up, the price of oil may go up, but the futures contract you're in may not. And so I show this chart to a lot of investors where, they can see that the price of oil on the front month contract went negative. But the thing is there was no ETFs, real investable solutions, other than maybe trading futures during this period in April, where you could have been paid to hold an oil ETF. The oil ETFs had already moved to other contracts. So this is sort of a canard in that you look at this negative price, but this isn't something that could actually be attained as an investor. If you were an investor, you were probably in one of the later dated contracts. And here's what I'm talking about when we're talking about oil futures contracts on the short end of the month. If we look, and I'm using April 30th, obviously we've seen a big rally in oil since then. Oil's over, most of these contracts are over $30 now. But had I been trading at April 30th, 2020, if I'd been in the July contract or the August contract, they would have been trading at 21.85 or 21.37. Now, if I'm only holding these contracts for less than a month or so, let's say I was holding the August 20 contract, I would have had to roll that from 20.37 to 26.37, or in other words, paid roughly $2 to roll that contract. That means that in order for me to make money over that contract roll, the price of oil would have to go above $2 and further for me to see some sort of capital appreciation on that return. And so any ETF products that only short dated contracts and are rolling them sort of in this 4 or 5 month window are paying this contango as they roll. Whereas you can go longer out in the curve and you see you have the December 20th contract at December 20 contract at 29.62 or December 21 at 34.95, where if you hold a longer dated contract, you're not rolling them as often. And that's really been the benefit of one of the oil ETFs that we offer, is that, for buy and hold investors, we have a product called the Horizons Crude Oil ETF, which is ticker symbol HUC, that seeks investment results before fees and expenses that endeavor to correspond to that longer dated contract, that December contract. And by doing that, it reduces the role of holding oil. So if you have a long-term view of oil, if your view is that maybe there's oil improving in price and what Nick is talking about happening in sort of Q3 or Q4 of 2020, then maybe this is a more appropriate product than the shorter dated contracts because it tracks that December WTI contract. And you can see with the performance of holding the strategy, and I'm just highlighting, holding the winter contracts versus the shorter contracts, if I hold the front month contracts, I'm down about 65% on a 6 month basis going into April 30th, where I'd be about 43% long term. Or over a 5 year basis, you're down about 15.42 per year versus 20.56. So significantly less volatility with that longer dated contract. But you'll see that even if you look at the prices today, that the December contract does move up with the shorter dated contracts, just not as much as those contracts, but it also provides less of that downside volatility. Now I'm going to pass it back to Nick here to talk about, the idea of actually investing in equities, because again, for buy and holding investors, energy equities may be a more appropriate solution given the kind of outlook that he's providing.
Yeah, thanks, Mark. And I think energy equities here in Canada really represent not only an opportunity if you think that oil prices are going to recover, but also just a really deep value opportunity. And the energy sector in Canada is trading at valuation levels that we really haven't seen in a long time. Over 10 years. The other thing to keep in mind is, as Mark mentioned, we keep talking about how there is no space for oil inventories, and that's really caused all that problems with the crude oil futures, one of the real advantages of owning energy shares in energy producing companies is that they have that oil in the ground. You basically have free oil inventory by just leaving it in the ground. And, a lot of those energy companies are deciding to do that. They're reducing production. They're foregoing expansion plans because the oil is worth more in the ground than it is being sold in the marketplace today. Now, if we look at valuation levels, if you look at price to book value or enterprise value to sales or dividend yield, and this is a trailing dividend yield, so it is a little bit lower than that because we have seen some dividend cuts. But on all three of those metrics, we're seeing valuation levels that are extremely cheap relative to even 2008 when we had the global financial crisis. So it's really offering compelling value. I think in 2018 and 2019, already we were seeing relatively good value, but this has created an even a better buying opportunity. Now, we have three ETFs. If you could scroll over for me there, Mark, because I'm having trouble doing it. Yeah, so we have three Horizons ETFs that own energy shares. The first one is CHXE. It seeks to replicate the S&P TSX Capped Energy Index. It's a total return index. It's the lowest cost energy equity ETF in Canada. So it gives you a broad, this is the index that we just discussed in the previous slide. It's market cap weighted, so it's very geared towards the senior producers. C&Q and Suncor together are about 50% of the index, but they basically will give you a broad market exposure at a low price.
And that's the same exposure. Sorry to interrupt, Nick. Yep. But that's also just for people on the call. That's the exact same ETF exposure as XEG, which is probably more well known to retail investors. But of
Correct.
course, this ETF has a much lower management fee, and has some tax efficiency as well.
Yeah, and so it basically tracks the same index that XEG tracks, but at a lower management fee than XEG. So that has that advantage. Then we have the Horizons Pipeline and Energy Services Index, CHOG. We really like this ETF because instead of focusing on the energy producers, which have seen like a lot of volatility because of the volatility in the oil price, this ETF focuses on the pipeline sector. And as many of you will probably know, in Canada, we don't have enough pipelines which is why our crude oil trades at a deep discount to U.S. benchmarks because we can't get it out of the country. And so all those pipeline stocks generally have a pretty good business going, where they're generally always operating at full capacity, other than when they need to do some repairs or changes and whatnot. But it provides a less volatile way of investing in an energy recovery. It has come down somewhat as well with the rest of the sector, which makes sense because it is oil producers can't afford to pay as much for pipeline space if they're not making any money themselves. But on the other hand, it is a less volatile business. It has a high dividend yield, which is great for investors that are looking for dividends. And it's slightly less volatile. If we look at the performance over, I think it's the next slide. If we look at the performance, we see that over the past year, the pipeline energy index is down 34%, as opposed to close to 50% for CHXE. So if you're really bullish on oil and you really think that oil is going to recover strongly, then CHXE is slightly more risky, but will give you more bang for your buck. CHOG, on the other hand, will do well as well, but will pay you a dividend and will also be less volatile.
I think it's important to note, Nick, and rightly so, that what you did there is that if you look at the long-term performance of HOG, you can see, like, just plainly see that it has much lower drawdowns, and that's simply because there's a lot of front-end costs for the oil producers to be going out and pumping oil or natural gas. The pipelines, once the infrastructure is built, it's just a case of charging locked-in pricing to transport that energy. So you will see demand for the pipelines decrease if there's a huge demand destruction. But if they still need to pay certain prices for the pipelines, and these pipeline companies don't have to, other than building the pipelines, they don't have to keep building into other types of infrastructure. They don't have to keep drilling, finding new exploration. So their hard-coded costs are less, and they can pay out a lot more of what they do with that dividend. So that's why you see such much lower volatility. But I think investors would be surprised that it does capture a lot of the upside that you see in a rally, obviously not to the same degree that HXE would, but over time that they certainly tend to converge as there's long secular demand for oil and energy prices.
Now, for our next ETF, I really like the prospect of this one. It's our Horizons Enhanced Income Energy ETF. It's HEE. Basically, it is an equal-weighted portfolio of Canadian energy producers and companies, which provides a monthly distribution of dividend using dividend income, but also a call option income strategy. We have a whole suite of covered call ETFs, and HEE is the covered call ETF that focuses on the energy sector. I like HEE right now because the volatility that we have seen in the energy space is, obviously, everyone knows, looking at crude oil prices, is beyond anything we've ever seen. And so the amount of premium that we're able to get on our call options for the portfolio that we have, is higher than we've ever had. And we use a dynamic writing strategy so that we're able to try to capture more of the upside. Now, one of the things with covered call strategies, if we go to the next slide, is that because you're selling a call option, you reduce your range of outcomes in terms of how much upside you're going to get on a portfolio versus having no options at all. By selling the upside call, you're receiving an option premium, but you're also capping your gains. On the one hand, that gives you additional income, which gets translated into a higher yield. But on the other hand, it also reduces your potential upside. But at the same time, it also reduces your volatility. So it's a bit of slightly a different way of playing the energy recovery. What I like about it is because it's equal weighted, unlike HXE, which is mostly geared towards the large cap stocks such as C&Q and Suncor, HEE has all equal weighted stocks, and so has more exposure to the smaller oil and gas names. Now, this has worked to HEE's detriment for the past several years because the smaller producers such as Crescent Point or Cenovus or Seven Seas Generation, all these names have really underperformed C&Q and Suncor because they have a lot more leverage. On the other hand, in a recovery, those stocks stand to do much better if we get a recovery in prices. So I think HEE, the combination of the equal weight and the higher volatility is definitely advantageous. If we go to the next slide here, it gives you a picture of what Suncor options volatility has looked like over the past 10 years. And you could see that the spike that we saw in options volatility, even in a big name like Suncor, this not even looking at smaller names, but a big name like Suncor, the volatility was more than double any previous all-time high in the past 10 years. Now, since the recovery, option volatility has come down, but still today it's almost at the previous all-time high. So we're still getting a good amount of premium on the call options that we're selling. We're getting a nice recovery in the stock prices. So for those reasons, I like HGE. If you look at
Nick, just on that
yep.
point, if I'm some investors on this webinar may not be familiar with options writing, obviously to the degree you are. What would that mean in simple terms, in terms of if I'm writing call options on Suncor, or they were looking at writing call options on Suncor, like what kind of yield would be established right now in generating like 1 month out of the money options on Suncor?
Yeah, well, it really depends on how far out of the money you're going to be writing your options, and whether we're using 1 month or 2 months or 3 months. Generally, we like to focus on shorter term options because that really maximizes the yield. With the volatility levels the way they are today, we're looking at annualized yields if the portfolio was fully written of over 10%. Now,
wow.
we try to reduce some of the call coverage that we've been putting on this portfolio because the volatility level is so high that we don't need to write as much to get the same amount of yield, and that allows us to capture more of the upside. The problem is, if the CHXE index, the S&P TSX capped index, it's up 100% from the lows in March, and so you want to make sure you're not capping too much of that upside. Now, when I say that it's up 100%, people will think, well, that means it can't go any higher. But we're still down 30+% from the beginning of the year. That's how big of a drawdown we've seen. So I think there's still a lot of potential for recovery. But yeah, so when we're trading those call options, we want to really be cognizant of maintaining that upside exposure.
And you would find that the movement of these stocks tends to precipitously obviously increase with the price of oil. So I mean, at $33 on the futures contract for oil, that's still very low relative to historical basis, right? Where most of these companies are, correct if I understood, they're kind of more geared towards like $50, $60 oil really for profit generation.
Exactly. And so I think they still have, if oil prices recover to, their average that prices were in the past, 10 years, then there's still plenty of room for prices to go higher. The other thing I might mention is, the improvement in the overall oil picture for Canadian energy producers specifically, given that now that the Alberta government has backed the Keystone Pipeline, and it's not a done deal yet. But if we can ever get that built, that would improve the overall picture for Canadian energy. As well, the U.S. shale, which really had been responsible for 100% of growth in oil production over the past 10 years of world global production, they're going to take a big hit from these lower prices, and they'll recover as well, but they'll probably take longer. They were already a little bit in trouble in the last couple of years where we'd seen production not grow as quickly, and they had a lot of debt issues. So I think overall the Canadian energy picture is looking good relative to the U.S. energy picture.
All right, I'll pass it back to you in 1 second, but I think we're going to take a bit of a segue here. We've talked about crude oil and energy, and I think a lot of you on the webinar had an interest level in where that's at. But when we started talking about an energy webinar, we did think that it was incumbent upon us to add uranium in there, simply because when Nick is looking at all the different commodities, I think uranium has been like the quietest rally relative to everything else that's going on there. People are hyper focused on the volatility in oil, and they're looking at tech stocks and vaccine. And meanwhile, one of the best performing commodity asset classes has been uranium. And Nick, you're sort of a, toot your horn a bit, but you are sort of a well-known commentator and observer of the uranium market. And we do have a uranium ETF, but I think, you really wanted to put in the fact that, one of the big winners out of this whole COVID-19 situation may not actually be a rebound in oil. It may be a move towards cleaner sources of cheap energy, which has been uranium.
Yeah, well, thanks, Mark. And I've had an interest in the uranium market basically my entire life. My father was actually a geophysicist and worked in the Athabasca Basin when I was a kid, and so I've grown up around many bull and bear markets in uranium. And the past 10 years have been a bear market in the uranium sector like none other. After the Fukushima accident in 2011, it was basically the equivalent of the pandemic hit in demand that we're seeing in oil today. We saw all of the Japanese nuclear power plants shut down immediately, and we saw Germany basically plan to take all their nuclear power plants offline. On top of that, you had China, which at the time people were predicting would be one of the big builders of new nuclear plants, and they shelved a lot of their immediate plans for new constructions. So it really, that event, almost 10 years ago, really put a big hit on demand. And the big difference between oil and uranium is that the supply picture didn't really change that much, as opposed to oil today, where all the oil suppliers are reducing output. In the uranium space, over the past 10 years, they didn't really cut output very quickly. And that's because Kazakhstan, which is kind of the equivalent of the U.S. shale, they started growing production at a very, very low cost, where they were still making money, and that flooded the market with uranium. And uranium prices have basically been in a bear market, basically, ever since recently. Now, on the demand side, we see things are changing. We're finally back, in terms of the nuclear space, we're finally back to pre-Fukushima levels. Nuclear energy still provides 10% of global energy production, and there are still 441 reactors generating electricity worldwide, and there's a further 50 reactors currently under construction. The other thing that we've noticed is, unlike in this current pandemic, we have not seen a big drop in demand for nuclear and electricity. There's been some, slower demand, in particular France, which generates 75% of its electricity from nuclear. But overall, there hasn't been that much of a lower demand for uranium. But if we go to the next slide, we'll see that on the supply side, the picture has changed almost entirely. It's quite fascinating. If you look at the top 10 producing mines in the world last year, 9 of them have either shut down or seen reduced production because of the pandemic. So if you look at Cigar Lake, that was the biggest uranium mine at the time, owned by Cameco. They shut it down due to COVID. This is on top of the fact that they shut down McArthur River the year before, which at the time also was the largest mine in uranium. So this is, we're looking at a large amount of pounds going off the market. But then Husab, which is a uranium mine in Namibia, they were shut down by the Chinese due to COVID. And then Kazakhstan went and also reduced output to the bare essentials on all of their own uranium mines. So we've really seen a drastic cut in supply without the equivalent cut in demand, and that has really propelled uranium to now close to 5-year highs on the price. If we go to the next slide, we'll see what the price of uranium has done. It's basically come back to kind of 2015, 2015 levels, and I think the prognostic is good for higher prices because inventories are being drawn out, and that was one of the big bear cases for uranium bears, that there was so much inventories on the sideline. But on top of that, Cameco isn't producing enough uranium at this point to fulfill their existing contracts, and so they have to buy uranium in the secondary market to fulfill existing contracts. If you look at the relative price performance of uranium prices versus uranium stocks, you'll see that there's quite a bit of room for uranium equities to catch up. So I think that the prognostic is looking very good from a supply-demand perspective. Now we have an ETF which tracks the Selective Global Uranium Pure Play Index. Ticker is HURA. I like to call it hurrah. And it is 75%, 75 to 80% is basically uranium equities, and 20 to 25% is uranium closed-end fund companies that hold physical uranium. So you get a good mix of both owning physical uranium through the closed-end companies, and you get a good exposure to uranium equities. Now, the two biggest uranium producers in the world represent about 40% of the index. That's Cameco and Kazatomprom. They're by far the largest producers in the world. And then the balance is junior companies, which, if we see a further recovery, stand to appreciate quite a bit more than the larger companies. So we think that this is a good way to participate both in the uranium equities recovering and as well as the uranium price.
So, in summary, and we're going to move it to Q&A. I know we've got some questions already coming in. But, one thing is to understand the time horizons of what you're doing here. And I think, I'll ask Nick about this afterwards, but, are you looking for a long-term buy and hold? We've clearly put out some things there showing you some of the risks, but also highlighting some of the opportunities in energy investing with mostly a long-term positive view. Things we have to hope are getting better from the global COVID situation. And if it does, what's the better time horizon? And the thing is that if you're a short-term tactical investor, maybe the futures offer some volatility for you to want to get into. But overall, I think a lot of investors are just trying to call a bottom or want an entry point for a longer term exposure, in which case they need to look at things like the futures contracts versus equities. So understand that risk return profile. Understand also that there's no simple one sector exposure to an energy. So, consider the risk return of different industry sectors. As we've highlighted, you have a very different risk return profile with the pipelines than you do with large energy producers like, CNQ or Suncor. They're going to behave differently based on what's happening in the market. If you have a range-bound market or at $40 or $35, then energy equities might be capped, where pipelines might do relatively well as they continue to pump along oil and pay out a dividend that might attract investors. So you do need to understand some of those nuances, and obviously there's ETF solutions across the spectrum for that. Look at whether uranium will continue to rally. We've obviously made a case that to at least put that on your radar as something that's a very interesting long-term opportunity, particularly as the Fukushima crisis sort of becomes more in the rear view mirror and people start to look at the long-term effects of that being somewhat muted, and nuclear energy as something that particularly comes online in the emerging markets like China and East Asia. We do have a robust product suite of commodity and energy focused ETFs. My sales pitch here is just at the end here is just know that these are the ETFs that we've mentioned today. These are the tickers of them, as well as the management fees. Again, you've got 5 ETFs right now that could be used in any different one of these themes to go on to the ETF space and find something that you may want to add some energy to your portfolio. All of these with fairly attractive management fees, which I've highlighted on this part here. With that, I'm going to move it to the Q&A. I know a few more questions are coming in, so we'll try to bring some of that in. One thing I'm not going to be addressing too much is questions around HOU or HOD, but I did have one question that is worth answering. Someone obviously was listening to the futures contract slide that I talked about and was asking about the futures contract positioning in HOU and HOD. Recently, those are 2 ETFs that we offer on the Beta Pro lineup. They moved to the October contract. They currently have the October exposure. So that would fit within that square, right? What I was highlighting with the HUC is that HUC has the longer dated contracts, which tend to be a little less volatile. Again, my main message with understanding the futures contracts rules is just that with the shorter dated contracts, you're going to have more price volatility on the upside and the downside, and you have the likely greater impact if the market is in contango. With the longer dated contracts, you may have less upside on a spike, but you have less of overall time of that negative roll yield from the contango. Again, it's about what is your long-term buy and hold outlook on those. Another question here for you, Nick, is just in terms of, as a PM and someone who follows this space, what would you view as a better opportunity for buy and hold right now? If I'm putting you under the gun as a PM, would you be looking at energy equities or the commodities themselves?
I like energy equities because they offer not only do they offer exposure to the oil's price, because on the one hand, if you're going to buy the commodity, then you obviously believe that oil price is going to go higher. But not only are you getting exposure, but also you're getting a very cheap equity. So there is a little bit more risk in buying the energy equities because obviously if the price stays low, a lot of them aren't making money at these prices. So there is a little bit more risk. But given the cheap valuation, I believe that you have it's a better bet. You have more upside than downside relative to owning the commodity outright.
Someone who clearly knows the uranium space here, and they're asking you, this is right out in your wheelhouse here, Nick. What would be better? Why wouldn't you not just buy CCO relative to HURA? So what would be the differences between those two exposures?
Oh yeah, well, I mean, first of all, HURA owns CCO, so you're definitely getting exposure to CCO by owning HURA. But HURA gives you 2 other things that CCO does not. First of all, CCO gives you, you have company risk, so you don't have very much diversification when you own that CCO. When you own HURA, you have a diversified portfolio of uranium equities. So even if there's a problem at Cigar Lake Mine or a problem at McArthur River Mine, these can really impact one stock, whereas HURA will obviously be impacted, but not as much. The other reason to own HURA is that it owns Kazatomprom, and Kazatomprom is the lowest cost producer in the world with a really good growth profile. So if you're betting on a uranium recovery, Kazatomprom, it's gonna be an essential part of the market when uranium recovers. So HURA gives you not only Cameco, but it also gives you Kazatomprom. The other reason is that we own juniors. The juniors, they're down. A lot of these junior companies are down 70, 80, even 90% lower than where they were at the high of the bull market, over 10 years ago. And so if we get a recovery in these junior miners, they will really help HURA outperform the more steady senior miners such as Cameco or Kazatomprom prompt. So what I like about Horizon, it gives you a bit more of a diversified mix. It also gives you spot exposure to the uranium price via the physical holdings that the closed-end funds own, like so letter U and Yellowcake. Those are the two. Closed-end funds that we own, and so I think it gives you more broadly diversified way of playing it.
In terms of the Canadian energy equity space, so moving back into the oil and energy, what's what's our kind of top line view there? Like, what do you? I know you said in your mind there's probably a little bit more upside on the Canadian energy side relative to the U.S. side, but at what point do we sort of hit an inflection point where that's a long-term aspect? Because right now we're kind of playing at a bottom, but ultimately, what do we need for the Canadian energy sector to be more of a long-term hold?
Yeah. I mean, I think we really need a couple things. First of all, it would be we really need to get one of these pipelines built. We've talked about it a lot in this country, and the Alberta government has really put all their chips on helping TransCanada Pipelines build their pipeline. But we really need to get one of those built so that we can reduce the discount that currently exists between Canadian oil and U.S. oil. So I mean, I think that would be a really if we can get a little bit more certainty there, I think that will really help the Canadian oil patch. But at the end of the day, I think that they offer such compelling value that you're not risking as much owning them at these lower prices than you would if you had to buy them a year ago or 2 years ago or 3 years ago. But we really need to for it to be a long-term outperformer and really get out of the rut that we've been in, we really need to reduce that spread between Canadian and U.S. benchmarks.
And you highlighted earlier the dividend yields that are generated. I mean, you've mentioned that with gross of fees kind of aspect on HEE, you could generate about a 10% yield with the covered call strategy. But I think some of these producers are already in sort of the 6 to 8% yield range. In your mind, I mean, how sustainable is that? Is that potentially an income trap for investors?
I mean, in the short term, potentially. I know that right now in the energy patch, if you look at where oil prices are today, they're not making money. So they are cutting down on capital expenditures to save cash flow. But one of the obvious places to cut is in the dividend, because this way you can save cash, and capital is very expensive right now in the energy patch. Nobody's going to be lending that much money to them, and so I think that conserving capital for them is more important than paying out dividends. And so I think there's definitely many companies where you'll see the dividend being cut or the dividend being at risk. I think that's okay. I think from a capital allocation perspective, that's the right decision. You want to be able to save capital today to make it through the tough time, so that when things recover, you have enough money to make it through, and you can benefit from the higher prices in the future.
Perfect. Okay, with that, we're at our 55-minute mark on the webinar. Any additional questions that we have, we will try to get someone from our client service representative team reach out to you. We also, as you can see up on the slide here, we are social, so if you have any follow-up questions, feel free to email us at info@horizonsetfs.com. You can even reference that you listened to the webinar. With that, thank you for joining us today, and good luck on your investment journey. Hopefully, we've given you some tools to empower you to get a little bit better sense of the context and ways in which you can look to potentially invest in the energy sector in a way with education and understanding of the risks and opportunities. Thanks again, everybody. Take care.